Hello, I'm Carl Thompson, creator of AccurateCalculators.com. Are you considering entering into a seller financing arrangement? Whether you are the seller or the buyer, you may wonder how you can confirm the balance of a note or loan. What if a payment is late? Or what if the borrower misses a payment entirely? Or what if the borrower underpays? Or what if the borrower decides to pay an extra amount? What if there are late fees or escrow? What if the terms allow for interest rate changes? Do you need an outside bookkeeping service or an accountant or an attorney to track payments and calculate a running balance? No, that won't be necessary. The Ultimate Financial Calculator can handle all these scenarios and more quite easily. And in this tutorial, I'll show you how. I'll teach you how to calculate a payment amount, accurately track payments, and calculate a penny-perfect loan balance or payoff amount using the Ultimate Financial Calculator, or UFC for short. Once you watch this video and try the calculator, tracking loan payments and calculating a current balance will be a relatively painless process. I'll start by showing you the basics. Then I'll follow up and show you some details you need to know. Make sure you watch to the end. Being aware of the details can help you avoid errors and save you some time. Seller financing, sometimes called owner financing, is when the seller of an asset, typically a car or a house, but it can be any asset, provides the financing for the purchase rather than a bank or other traditional lender. Here's how to track a loan. After agreeing on a price, the seller and buyer must agree on a payment amount. The UFC will calculate the payment for you. Here are the steps. Click on New to clear any prior entries. For our initial interest rate, we will assume 6.5%. I'll leave compounding set to monthly. The schedule type will already have been set to loan, and we will leave the calculation method set to normal. In the first row, set series to loan. Since we're only calculating the loan's payment amount, we can assume that we do not know the closing date. I'll accept the default date. Enter the amount, $425,000. The seller is making only one loan. Enter 1 in the number column. Tab to move to the second row. Under Series, select Payment. We'll accept the default date, which should be 1 month from the loan date. For the amount, I will type a U for unknown. The seller has offered to finance the purchase for 180 payments. I will enter 180 under Number. Click Calculate. The payment amount is $3,702.21. Setting up the calculation this way results in a conventional payment amount. That is the amount that it takes to pay off the loan, assuming that the time between all periods is the same length. That is, 1 month as set in the frequency column. The calculator calculates the last date in the series based on the number of payments and the frequency. The user cannot change it. You could enter the actual closing date and the first payment date, and if the first period is longer or shorter than all the others, the calculator could calculate an adjustment payment amount. But that's different from what most people want. If, however, you want the calculator to calculate an adjustment payment amount, allowing for long or short first periods, you must set the interest rate options. I have another tutorial about interest rate options. I'll link to it in the description. For now, we'll go with the conventional payment amount. That is $3,702.21. Now that we know the payment amount, we are ready to track the payments. The first thing we will do is set our rounding options. Click on Settings, select Rounding Options, and select Open Balance, No Adjustment. Click Save Changes to close. Our interest rate is still 6.5%. We'll leave the compounding set to monthly, the schedule type set to loan, and the calculation method set to normal. Our loan's set up for $425,000, but now we know the closing date. The closing date of the loan will be February the 1st, 2024. Let's tab to the second row, change the first payment date to March the 1st. Leave the payment amount as calculated, and this time we will set the payment to 1. We are receiving 1 payment on March the 1st. Tab to the third row, we will receive another payment on April the 1st. We'll set the payment amount for $3,702.21. Now, let me show you why we set the rounding option to open balance. Click on Schedule. Skip the title page. Rather than the amortization schedule showing a 0 balance, the schedule shows the loan balance after the last payment, $422,192 as of April the 1st. As you can see, tracking payments and calculating a current balance is straightforward. Just enter the payments as you receive them. Let me point out that you can click on File, then Save As, to save your entries to a file on your local computer's hard drive that you can later load to continue where you left off. That's the basics. Enter the payments one by one for the specific amount on the date the borrower makes them, but I promise to go over some details you should know about. In the last lesson, I showed you how the calculator tracks the loan balance after a payment. But what if you want to know the balance between payment dates? It's easy. Continuing with our example, click on the first empty row, and let's say we want to know the balance as of April the 20th. Tab to the amount, type a U for unknown, and let's click on Calculate. The amount is $423,640. Look at the schedule. You'll see that the calculated final payment amount includes $1,448 for the accrued interest that is due to the lender through April the 20th. Technically, the amount calculated is the payoff amount. You can enter any date you need, but if the borrower had missed making payments, you may want to enter the missed payments as 0 amounts. Let me show you why. Change the date in the last row to say June the 20th. Change the amount to unknown. Calculate. The payoff amount is now $428,242. Let's look at the schedule. The accrued interest is now $6,050. Why did I say you might want to enter the missed payments? Here's why. Close the schedule, click on the last row, and click the Insert button twice. The May 1st payment is 0. Click on the 5th row, change the date to June 1st for the June 1st missed payment. Change the amount to unknown and click Calculate. The amount is still $428,242. But when we look at the schedule, we see that it will show the accrued interest for the 2 payments missed. Whether or not you want the schedule to show the missed payments is a personal decision. Also, if you don't want to calculate a loan payoff amount, but want the schedule to show the loan balance as of a particular date, you can always enter a 0 payment as of the date you want to know the balance. But unless a payment is due on that date, you should remove it from the inputs, as it's possible for zero payment entered between payment due dates to alter the interest calculation slightly. What if the borrower wants to make an extra payment? The calculator gives you two options. I'll delete rows 5 and 6. And for the payment due on May the 1st, rather than entering the scheduled payment amount of $3,702, we'll enter an extra payment of $500 by adjusting the payment amount. So enter $4,202.21. The schedule, of course, shows the extra amount. The point is that the calculator allows the user to enter any payment amount, either an over or under payment. But there's another way to enter the extra payment. Close the schedule. Change the payment amount in the last row to $3,702.21. Tab to the next row, click on Series, and this time set it to extra payment. Let's say the extra payment is going to be on May the 15th. And we'll enter the $500 amount. Click on the 6th row and enter another regular payment as scheduled, June the 1st. $3,702.21. Let's go to the schedule. Since the user identified the May 15th payment as an extra payment, the calculator applies the total amount to the loan principal. Note that I could have also entered 2 rows for a payment, with each row showing the same date. This way I can indicate that part of the payment received is for the scheduled payment amount, and the other payment is for an extra payment. There are other features that you should know about. The user may enter a comment for any row with a number 1 in a number column. Let me show you. Click on Cash Flow Options. Click on Comment. And let's say the borrower paid with check number 1001. I will leave this option so that it appears on a schedule set to Yes. Click Save Changes to close. Go to the schedule, and here's a comment. The comment appears below its related payment. What about fees? Let me show you. Click on the first empty row. It will be for payment due on July the 1st. Let's change it to the 20th. Enter the normal payment amount, $3,702, and tab to the next row. Under Series, change payment to fee. Change the date to July the 20th. And tab and enter our late fee of $50. Let's document what the late fee is by clicking on Cash Flow Options. Click Comment. July 1st payment received 20 days late. Click Save Changes to close, and let's look at the schedule. Skip the title page. Take a few seconds to look at that July 20th payment. Because the borrower made the payment late, the payment is not large enough to pay the interest that has accrued. It is nearly $12 short. The $11.93 shortage increases the principal balance. When a loan's balance is increasing, we say we have a negative amortization. The negative principal amount is in the principal column. Let me show you two more things. Earlier, I had said that zero payments may slightly impact the interest calculation. Enter a zero payment for July the 1st. Click on this row, click Insert, and we will have a zero payment inserted automatically for July the 1st. Let's go back to the schedule. Scroll down, and we can see that the balance has changed by 1 penny. The difference is due to interest rounding. Also, you should be aware of the U.S. rule. The United States Truth in Lending Act mentions the U.S. rule. The rule states that the lender cannot charge interest on unpaid interest. A calculator must track unpaid interest separately and not add to the principal balance. The rule is not compulsory, however. Let me say that again. The lender does not have to adhere to the U.S. rule. But let me show you the impact. Click on Calculation Method and select U.S. rule. Now let's go to the schedule. The balance after the late fee using the U.S. rule is $418,982. I know that I'm getting into the weeds, but I want to be thorough. I know a lot of viewers will use the UFC to audit loan payoff amounts. I want you to understand settings that impact calculated results. Next, let's look at how to adjust interest rates. The Ultimate Financial Calculator also supports interest rate changes. The user may change the interest rate as of any date. Let's assume that the borrower makes the next 7 payments on time and for the scheduled payment amount. Also, let's assume that the interest rate increases by 0.25% on the anniversary of the loan's origination date, which will be February 1st, 2025. Let me show you. Click on the next empty row. It will default to payment. The next scheduled payment date is August the 1st. Enter the scheduled payment amount. And I said the next 7 payments will be paid on time. The last payment of the payment series will be February the 1st, 2025. Under the series column, on the next empty row, select Rate Change. Set the date to February the 1st, 2025. The new interest rate will be 6.75%. Now notice, if the terms of the loan change and call for a compound frequency change, you can change them by clicking on compounding in the series options. I'll point out that this None option under compounding means that interest will not compound on the rate change date. We will leave compounding set to monthly though. Also, though I showed the rate change on the same date a payment is due, this is not required. The UFC will support loans where the interest rate might change on any date. There is one more step. When the interest rate changes, we expect the payment amount to change, and though it wouldn't necessarily have to. How do we calculate a new payment amount? Click on the first empty row. It will default to payment. Set the next payment due date, which is March the 1st, 2025. Set the payment amount to unknown. Now, the lender had originally agreed to 180 payments to pay off the loan. 12 payments have been made. That leaves 168 payments, which we will enter in the number column. We can click Calculate, and the new payment amount will be for $3,754. Of course, the borrower is not paying 168 payments now. They're just paying one payment. So therefore, we will set the number back to 1. Next up, we will talk about escrow. If the seller is financing a mortgage, they may want to collect the money to pay property taxes and insurance. If so, the Ultimate Financial Calculator supports this as well. Click on Schedule Type and select Escrow. I'm not going to spend much time discussing the escrow feature. It should be largely self-explanatory. Let me point out some of the basics, however. The calculator tracks payments from the borrower to the lender with the series set to escrow. The calculator tracks payments from the lender to the property tax authorities and the insurance companies with the series set to escrow disbursement. The escrow schedule type supports the same features as the loan schedule type. You may add comments to any row with the number column set to 1. This is so you can document where disbursements go. Be aware that if the payment amount the borrower sends the lender includes the escrow amount, you will need to enter only the principal and interest portion of the payment in the loan schedule and the escrow amount in the escrow schedule. From the perspective of the Ultimate Financial Calculator, the loan and escrow schedules are two completely unrelated schedules. You do not need to enter an interest rate. If the user enters an interest rate, the schedule will accrue interest. If the escrow balance is positive, that's the interest owed to the borrower. If the balance is negative, the borrower owes the interest to the lender. If the borrower is not entitled to interest on the positive balance, the user can change the interest rate to 0 when the balance goes positive. Stick around to learn about one caveat. I have one caveat that I want to mention. At the start, I showed you how to calculate the payment amount. The loan example used throughout the tutorial assumes that the first period's length is exactly a month. Or looked at more broadly, the length of the first period exactly equals the length of the scheduled payment frequency. However, this is rarely ever the case. More often than not, the time between a loan's closing date and the first payment due date will be longer or shorter than the scheduled frequency. This means the interest due on the loan will be greater than or less than what would be due if the length of the first payment period equaled the scheduled frequency. In our example, a month. You may want to adjust the payment amount if you run into a scenario where the first period is irregular. If you do not make the first period adjustment, the calculator will adjust the final payoff calculation as needed. I'm not going into detail about this because I have an entire tutorial dedicated to the first period interest calculation and the options the calculator supports for handling long or short initial periods. I'll link to the tutorial in the description below. Let me give you one example though. Taking the example we've used throughout the tutorial, let's change this date to say January the 20th. This gives us a long initial period. It's longer than 1 month from the loan closing date to the first payment date. We'll look at our interest options. For long first periods, the default is with origination. Save our changes and look at the schedule. You will see with the origination date a payment and the interest due of $920. This is called odd day interest for that long initial period. And when it's collected with the origination, it's also known as prepaid interest. As I mentioned, there is a tutorial discussing this on our YouTube channel. I hope you have found this tutorial useful. And should you participate in a seller financing transaction, you won't shy away from the necessary record keeping. Remember, if you have any questions about this tutorial or any calculators found at accuratecalculators.com, please feel free to ask them in the comments below or in the comments section on the website below the calculators. And if this video helped you out, please give me a thumbs up. That helps me out. Thank you for watching.